Thank you for taking the time to listen to our show today. I'm Jason MacGregor. I'm the host of the MacGregor Wealthcast. Each episode we will be discussing topics we believe to be important to our clients.
And welcome to our podcast this week.
Hi everybody, this is Jason MacGregor, and I'm the co-owner of MacGregor Wealth Management. And welcome to our podcast. Today I'm joined by
Cory Laird. Good morning, good afternoon, good evening.
Hi, Cory. Cory is a certified financial planner, and we focus on financial planning and investment management for our clients. And today we're going to be talking about required minimum distributions, better known as RMDs. And we're going to talk about what they are. We're going to talk about why we're talking about them, why they're important, and also we're going to be talking about some strategies to help navigate the pros and cons of these RMDs. So let's just start with the basics here. What is a required minimum distribution? A required minimum distribution is the fact that if you have money in retirement accounts, not Roth IRAs, but any other type of 401k, 403b, traditional IRA, and you are age 72 or older, the IRS mandates that you take money out of those accounts on an annual basis. That is a law. They force you to take that money out. Now, for decades, the age that we used to use was age 70 and a half. Now it's age 72. That is new as of 2020. The CARES Act was passed last spring during the COVID crisis, and it was a law that had a lot of changes, but a couple specific changes to RMDs, relevant to RMDs, were one, in 2020, you didn't have to take money out of your IRA account for a required minimum distribution, which was nice. Okay, that was a good thing. And they also raised the age to 72. So that's new. So for all of you out there who are getting close to 72 or are there, this is relevant. So some mechanics behind it. The way it is designed is every year your IRA account gets valued on December 31st, and there's a table, IRS table 590-B, that has a life expectancy table, and you do a calculation and your distribution is calculated to the penny. And you have to take that money out at some point during the calendar year. How you take it out, when you take it out is completely up to you. We have clients who call us on January 2nd and they ask to take their distribution at that point. We have clients who want to do the math, do the total distribution for the year divided by 12, and they get the money out systematically. And we have a lot of clients who wait until the end of the year, after Thanksgiving, November, December timeframe, and take the money out at the end of the year. Again, when you take it out is up to you, whatever your cash flow needs are. The key is you have to take the money out. If you think you can pull one over on the IRS and not take it out, chances are you're going to get caught. All this stuff gets tracked. It's easily flagged. And the penalty for not taking a distribution, if you willfully don't take your distribution and you're caught, the penalty is severe. It's 50% of what you should have taken out. And you can go to the IRS publication 590 to see the factors that you use. But in round numbers, when you're 72 years old, approximately what has to come out is about 5%, that goes up a little bit each year because the factor gets smaller. So, if you've got a $500,000 or $1 million 401k that you've rolled into an IRA or it's still the 401k, we're talking serious money here. It's common for us to see $40, $50, $60, $100,000 required minimum distributions. So it was really nice that last year you didn't have to take that taxable income, and that's the key here is that when you take that money out of the retirement accounts, it's taxable ordinary income to you. And that's why there's the law. The government wants to tax that money. That money's been in there for decades as you've been saving. You've never You've never had to pay taxes on any of the gains or the growth. It's a big bucket of money that the government slowly wants to tax. And as I said a couple minutes ago, the program or the rules are designed so that you have to take a little bit more out each and every year. And if you only take your minimum distribution, you'll never outlive it. But it will grow and the taxes are there. So we talk about that. We talk about this because of the taxes, and that's why it's important. But I want to ask Cory here, are there any strategies that that are out there that help minimize those effects?
Yeah, and I would say that there are several strategies that are involved here with required minimum distribution with RMDs. Generally speaking, we go with the largest five here. Is that first off, if you're still working in your early, mid, late 70s, and you have a work retirement, a 401k or deferred comp, and you're still working, putting money into it, and you're not a 5% owner of that company, then you don't have a required minimum distribution of that 401k. You do on your other retirement accounts, your IRAs, your other old 401ks from other companies, but that one particular 401k from that one particular company you're still working for, you don't have a required minimum distribution for that company. So that's nice to know that you don't have that RMD from that account. And if you don't have to, then why would you take it out? Another recommendation, another strategy would be, if you're still working again and you're in early, mid, late 70s, and you want to put money into a traditional IRA, strangely enough, back in 2020, last year, the Secure Act was passed, and it changed the rules that after the age of 72, if you're still working, you can put money into a traditional IRA. So it's kind of funny because you are forced to take money out of that traditional IRA, but you can also put money back into the traditional IRA. So if your RMD is, say, $5,000, you can put up to $7,000 back into the traditional IRA. So that's certainly a strategy to kind of kick the tax can down the road a little bit. You can force to take it out, but you can also make a contribution for that year. Another small rule, I would say, less common, is if you are married and your spouse is more than 10 years younger than you, then you can have your RMD be recalculated as a lower percentage amount for the rest of your life because of that reason. So it's basically calculated based on their age, not on yours, and therefore you'd have a smaller percentage that you'd have to take out. And that only qualifies if you have a spouse that's more than 10 years younger.
And I'll jump in here and say that these are small strategies to help minimize the taxes. And sometimes people say to us, well, we don't need the money. And this doesn't help you tax-wise because as that money comes out, but you're not forced to spend the money. You're just forced to claim it as income. So if your cash flow is strong enough that you don't need that money, you can put that money back into a taxable investment account so the growth keeps going. You're not forced to spend it. So, but that doesn't help you minimize your taxes. So, but it is something that we get questions about all the time, which is, what do I do with the money? And spend it. It's income. Enjoy it. You're retired, and go do something fun with it, or travel or whatever. But the option, if it's a larger amount, is that you simply move the money over into your individual brokerage or joint brokerage account and continue to grow the money that way. So just a quick side note here.
Yeah, sure.
But really, what we're thinking about on most of the time is, how do we minimize the taxes? And it's tough. It's tough to minimize the taxes on the RMDs because the laws are fairly airtight and there's not much wiggle room. But there is one major strategy that we want to touch upon that will, reduce or eliminate taxes on the RMD.
Yeah,
Cory's, what's that called?
Yeah, there's two strategies. One that's if you're before the age of 72, and there's one that's after the age of 72. So if you're already 72 or older, the one strategy that Jason mentioned is the qualified charitable distribution. It's the QCD strategy. It's a rather unknown strategy, frankly, but basically what it comes down to is you can send the money directly from your retirement accounts to a charity of your choice. That can be nice because if you have a church or if you have a charity or whatever qualified 501c3 charity, you can send money directly from your account to them, and it is deductible. Therefore, it is not taxable. So if you have a $10,000 RMD and you typically give $2,000 or $3,000 to a charity per year, instead of paying it out of your pocket, out of your bank account, you may pay it out of your IRA, and that allows that money to be tax deductible. So it is tax deductible. It is above the line deduction. Normally, when you give to charity, it's a below the line deduction. And as many of us know, the standard deduction is so large these days that it's very hard for it to be itemizable. But when it comes out of an IRA, it's an above the line deduction, which means it is a deduction for everyone. No matter what your income is, no matter what your standard deduction is, it is a deduction for everyone.
So we've seen the interest lately pick up a lot in that. That with that standard deduction being doubled, that's a game changer for for QCDs. So we are starting to see that being a great strategy for those of you who are charitably inclined, are taking the standard deduction. And for most people, they give to charities not because they get the tax deduction, but it's a way to get both. Yeah. Continue your charitable giving, maybe even increase it. We've had clients who've given more to charities because they can reduce their taxable RMD amount. So the Cory's example, if you've got your $10,000 a year RMD and you give $3,000 directly to the charity through the QCD methodology, then you only have to claim $7,000.
And as a point of caution here, and this is a common error with this strategy, is if you have you have an RMD of $10,000, but you normally take out $15,000 just for your own spending. You need the cash flow, you're supplementing your income, and you take $15,000 out, but you also want to give $2,000 away to charity. It doesn't work like that. If you take out $10,000 of your $10,000 RMD for yourself, the QCD only works of the required minimum distribution amount. Anything above the required minimum distribution that you take out, the QC does not count. So it's common error, but it's something to be noted. I'd say the second strategy here, before you're age 72, is Roth conversions. We've talked about this with many clients, but as Jason mentioned earlier in the podcast here, is that Roth IRAs and Roth IRAs do not have a required minimum distribution.
Why not?
It's because it's not taxable.
That's right.
The IRS does not care so much that if you have money in that you don't keep it in there. They do care about you keeping money in a tax-deferred account like an IRA or 401k, and so they make you take it out for taxes. So Roth conversions, it's putting money in it's from a traditional IRA to a Roth IRA. It's taxable in the year you do it, but it reduces the balance in those traditional IRAs in the future.
Yeah, and Roth conversions are a whole separate topic. Yeah, let's make a note to maybe our next podcast can talk about the benefits of Roth conversions. It's something we could talk about at length on its own, but we'll just throw it out there as a strategy. You want to do it in a low tax bracket year. It doesn't get you out of paying any taxes at all. It's a minimization strategy. So let's make a note to do a podcast in the near future about that, because it's something that requires pre-planning. It's not something you can do when doesn't work real well once you're in your 70s. You want to do it earlier than that, optimally. But we'll get into that in an upcoming podcast. So required minimum distributions, they're back and they're in full force. And it's something you have to deal with on an annual basis. It's a taxable event unless you utilize that QCD strategy. There are a few things, as Cory's mentioned, to help minimize it, and the rules are fairly clear. And we're in the business of helping our clients preserve and protect and help grow their assets. And if you have any questions about what you should be doing specifically, please let us know. We can be reached at 518-499-4565, or my email is jason@mmwealth.com, and Cory is Cory@mmwealth.y. That's CORY. And we're here to help. Thanks for taking some time out of your day to listen, and we'll talk to you soon.
MacGregor Wealth Management is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability. Information presented does not involve the rendering of personalized investment advice and should not be construed as an offer to buy or sell or a solicitation of any offer to buy or sell the securities discussed. Different types of investments involve varying degrees of risk, and there can be no assurance that any investment or strategy will be suitable or profitable for an investor's portfolio. There are no assurances that an investor's portfolio will match or outperform any particular benchmark.